Hello, I'm going to give you a brief overview of a venture capital term sheet. This is in Moodle. You have a full copy of it, which is downloadable. And in this video, I am going to go through some of the key elements of this simple term sheet, as it's called. I will not be covering all of the elements. I will be covering the ones which are, I think, most important, as well as the ones that may need a little more explanation because the wording may be unfamiliar to you. So please try to follow along with the term sheet. If you can print it out in advance, that'd be great. If not, I have cut and pasted the sections we'll be talking about in the slides here, so you'll be able to see them. Okay, so the first element usually is sort of a little bit of a preamble, which says that this is a Series A preferred stock financing of the name of the company. Series A, what the letter means is that this is the first one. So if this is the first financing that the company is having, equity financing, that will be called Series A. If it's the second, it'll become called Series B. And if it's the third, it'll be called Series C. So you get the pattern there. So that's really all that Series A means. The one thing it does say in here, that which is the second sentence, it says that the no shop confidentiality clause and the counsel and expenses clause or provisions of this term sheet shall be binding even if there is no final agreement reached in these negotiations. I will talk a little bit more about the no shop confidentiality clause, but it basically means that the company will not take this term sheet and the valuation and the amount of financing, etc., and go shop it around to other potential investors to try to get a better deal. So the terms of this need to be held confidential unless the investing firm or the potential investing firm says it's okay to go talk to others. Other than that, that's about the key elements of this particular clause. So here's a couple of other key terms. Closing date. It basically says as soon as practicable. What does that mean? Well, it means first we have to agree to the terms, and then we have to get through a whole bunch of conditions to closing, which are later on in the document. And then we'll actually have a closing, just like you would a closing on a house. People get together, sign papers, and the company gets a check. The venture capitalist writes a check and gets it deposited into the company's bank accounts. What the next section says under investors is that in this example, oftentimes there's more than one investor when it comes to making an investment in a startup company. So I think in the almost 40 investments that we've made at High Peaks and Primary, I think there's only 2 or 3 where we were the sole investor. All of the other investments we made, there was at least one other party making an investment as well. So that's what this sort of lays out here. It says that investor number 1 is going to buy a certain number of shares, which represent a certain percentage ownership of the company, which is equivalent to a certain number of dollars. Sometimes, typically at this point in the term sheet, it'll just be talking about dollars, not necessarily lay out shares and percentage ownership, but there's no harm done in doing it. And in this particular example, there's going to be 2 investors. So one might say we're going to raise a total of $3 million, and investor number 1 is going to invest $2 million, and investor number 2 is going to invest $1 million for a total of $3 million, just as an example. Okay, so as we said before, the amount raised would be the total amount of money raised in this financing. And here it talks about conversion of principal on bridge notes. So oftentimes, particularly if this is a Series A, meaning the first time that institutional investors, a private equity firm or a venture capital firm, has invested in this company. Prior to that, there are oftentimes angel investors who invest, and oftentimes the instruments they use are what's called a convertible note. So it's actually a note, a loan, given to the company, which says that I'm going to loan you this amount of money for this period of time. And if there is an equity financing within that period of time, then my note converts into shares of stock as if it were part of that equity financing. So that's what that second half of that amount raised clause is covering. Price per share is a calculated number based upon pre-money valuation and post-money valuation, which you learned about other places in this course. But it just basically lays out price per share. So there is something called pre-money valuation, which is how you, in essence, calculate the value of the shares of a company. We're going to do a whole section on valuating early stage companies. So there's a lot of different considerations that go into that. But from an entrepreneur's perspective and from an investor's perspective, this is one of the real key areas, and this is where there's usually a lot of negotiating. So, for example, if the entrepreneur feels that their company is worth $5 million prior to this investment, and the venture capitalist wants to invest $1 million, but the venture capitalist may feel, we only think the company's worth $3 million. So you can see that $1 million investment in a company that's worth $3 million buys a much larger share of that company than $1 million investment in a company that's worth $5 million. So that's why this is an important element, right? Because it will reflect the percentage ownership that the investors have. So that's why they're very interested in it, which eventually relates to if there's an exit or a sale of this company, the amount of money those venture capitalists will be getting. And it's very important to the founders or the company or the entrepreneurs, because for each percentage more that a VC owns, it needs to come from somewhere, and it comes from the founders' shares or other existing shareholders. So because the number of shares, or I should say the percentage of ownership or the percentage of the company, let me try that one more time. The percentage of the company, there's 100% of the company. That's always 100%. And so if I own a certain percentage and you own a certain percentage and the founders own a certain percentage and the investors own a certain percentage, all of those percentages added up, always add up to 100%. So that's why this is important. So if I'm getting more, that means somebody else is getting less percentage ownership. So that's why there's a lot of time and energy and effort negotiating the pre-money valuation. There's some other things that you can do that influence the pre-money valuation, and I'll get to those later, but this is usually a big sticking point in most negotiations. The capitalization here, that just means there's an exhibit which is going to say, here's all the people who own shares of stock or have ownership in this particular company. So that's just what Exhibit A would be. Okay, let's talk about dividends. I don't think I mentioned this earlier, but in 99.9% of financings that are done by private equity firms or venture capitalists are done in an instrument called preferred shares. So what does preferred shares mean? It means that they have some extra rights or privileges or some benefits that common shares do not have. Common shares are the shares that the owners of the company, the founders of the company will have. If there's a stock option plan, the employees would be getting common shares. So there is this differentiation between preferred shares and common shares. Oftentimes, preferred shares will carry a dividend, an annual dividend. That could be anywhere from 4 to 8% these days. It sort of changes with the economy. It's negotiable. And this is in essence basically just a sweetener that the preferred shares are getting. So if they invest $1 million and there's a 5% cumulative dividend, they're getting an extra 5% on that $1 million every year. So it is important. It's almost always there, and you can usually negotiate that a little bit. Okay, let's talk about liquidation preference. This is one where you can sort of play around with the effective pre-money or post-money valuation. And what I've taken in many of these sections that we're talking about is in the term sheet that was the document that was in Moodle. Sometimes there were several different options given that you could go with. I know one of those was in liquidation preference. I think they talked about 3 or 4 all different alternatives. What I've done is try to take the one that is most common, and we can talk about that, where in essence, you know, there's just different flavors of the same thing for all intents and purposes. So in liquidation preference, this is what's called full participating preferred stock. So here's what happens. Let's say that I own, the institutional investor, own 10% of the company, and for that 10%, I paid $1 million. So let's say the company is sold for 10 million. What this says is out of that 10 million in proceeds, I, the institutional investor, get to take out $1 million first, plus any of those dividends, right? So if I've been an investor for 5 years and I've been getting a 5% dividend on $5 million bucks, it adds up. So I get to take out that total amount of money first, okay? I get to keep that, and now we have like $8.5 million left, right? Because we sold the company for 10 million. Now I take my 10% share, and let's say you, the founders, the other 90%, and we divide up that $8.5 million that's left. I get 10% of that, and you get 90% of that $8.5 million. So you can see that I sort of get to take out my piece first, and then we get to share in what's left. This is a way of sort of, the main reason for this, let me just talk about the main reason. The main reason for this is when there's a suboptimal outcome. What I mean by that is, let's say when we made this investment, you and I the institutional investor, let's say you the entrepreneur, thought that we would sell this company for 100 million bucks. And you'll see later on that when something like that happens, this provision actually goes away. And we just share in I get my 10% of 100 million and I'm happy. But it's when the number is lower than we sort of thought, that's when this liquidation preference really kicks in. And you will see, I think later on here, that there's a clause that puts a cap on this. So if I'm getting out at least 10 times my money, then this clause goes away. You can negotiate this a little bit. This is full participating preferred. There are different flavors of this that are laid out in the term sheet itself. But in essence, the concept here is that the investor gets to take out a slug of money first, and then we all, including the investor, get to share what's left over. Sometimes these liquidation preferences will say it'll pay out 2 times the original purchase price or 3 times the original purchase price. So again, these are ways in which, if you think about it, the investor is sort of playing with that number of what the pre-money valuation is. So if it ended up lower than they really wanted by saying, hey, we're going to take out 2 times our original purchase price up front, they're in essence getting a higher percentage of the company than the original valuation stated. So in any company, the shareholders get to decide lots of things, and many of those things that the shareholders get to decide will be laid out in the term sheet. Some will not, but they are often laid out. Either they could be laid out in the bylaws, they could be laid out in this term sheet and the subsequent documents that get generated from a term sheet like this. But this basically says that the Series A preferred shares shall vote together with the common. So, and what the on and as converted basis means that sometimes there's a 1-to-1 conversion ratio for preferred shares to common shares, which is probably the most common. Other times for every preferred Series A share I have, it will convert to maybe 2 or 3 common shares. So here's another place where the conversion, which we'll talk about later, you can start again playing with that pre-money valuation that you talked about, right? Because I'm going to actually get more shares of stock than initially looked like I'm going to get. But anyway, this is basically laying out how many votes each shareholder gets. So this is basically saying that the Series A will vote with the common as long as there's a certain percentage of shares outstanding, blah, blah, blah. And that the Series A is entitled to elect 1, 2, 3, again, negotiable, members of the board of directors, and that the company's certificate of incorporation will provide that the number of authorized shares of common stock may be increased or decreased with the approval of a majority of the preferred and common shares voting together. So if you want to make certain changes, we have to have here it's just a simple majority. Sometimes you can make that a super majority. Sometimes you can make it 2/3. Again, by playing with the percentage of votes that you need to make certain decisions, it's a way of giving the preferred shareholder a disproportionate amount of power or influence over the company with respect to the total ownership they have. So this is where oftentimes when you hear people talk about, well, as long as I own 51% of my company, I'm in control. It's in these types of clauses, the voting rights and a few other ones, where that can get changed. You may own 51%, but it turns out that actually that VC or that group of VCs who collectively own 25% actually can prevent you from doing a bunch of stuff. And we'll talk about that in subsequent slides as well. Okay, here's another clause. These are called protective provisions. And here again, it's basically saying that there's a whole bunch of things the company cannot do without approval of at least of a certain percentage of the company's Series A preferred shareholders. Okay, so this doesn't even take into account the common shareholders. It's saying there's certain things you can't do unless you get approval of the Series A preferred shareholders. Now here, this percentage is again something you can play with. You know, is it require 40%? Does it require 51%? Does it require 75%? So those are, you know, the higher those percentage requirements are, excuse me, oftentimes the more agreement you have to have within that voting block of Series A preferred. So if you have 3 venture capitalists who've all invested in Series A, and let's say they all did equal amounts, you may want to make it that you need at least 63% of those shareholders to vote in order to pass something. So one shareholder cannot control it. You actually have to have agreement among at least 2 out of 3 of those Series A preferred shareholders in order to vote something. And here's a bunch of things which will be on the next slide, which this basically controls. And here again, these are negotiable. The items on this list are negotiable. So you cannot amend, merge, consolidate, or otherwise sort of change the company. Now let's go to the next slide. So here's a long paragraph of all the types of things that you need approval from the preferred shareholders in order to do, right? So there's liquidate the company, which is basically sell it in any way. Liquidate can mean a bankruptcy sale. It can mean you sell it to Google. It can be either of those. It says a merger. It says amend, alter, or repeal any provision of the certificate of incorporation or the bylaws. Create additional shares of stock. I'll let you read this. I won't go through each one. Talks about changes in the board of directors. It talks about taking out a big loan inside the company, right? The company wants to take out a loan. Why does, and you say, well, why does an investor care about that? Well, if you remember, even though I may own preferred shares, when it comes to liquidation, i.e. let's say we're having a bankruptcy sale of assets, people who are loan holders, i.e. that you own money to, the bank, for example, they get to stand in line when it comes to liquidation in front of the shareholders. Now, the preferred shareholders get to stand in line in front of the common shareholders. So as a preferred shareholder, I don't want the company to take out a whole bunch of loans that then if we sell the company at a fire sale, all of that money goes to the bank and I get none of it. So that's why these things are in here. They're often called protective provisions because what they're doing is they're protecting the investment of the institutional shareholder or the private equity firm or the venture capital firm. Okay, another real important clause is called anti-dilution provisions. I think there were, again, several alternatives laid out in the term sheet. I'm just going to talk about one version of it or one flavor of it. So this basically says, here's the concept. The concept is you raised $1 million from me, and let's say for that $1 million I own 20% of the company, and that 20% represents, let's just say 2 million shares of stock. So just to make it easy, right? Well, wait, let's back that up. $1 million, let's say it's 1 million shares of stock. So basically each share of stock is $1. So that's what we sold those shares of stock for, those preferred shares of stock to me. Let's say a year goes by and we have to raise some more money. And stuff is not really going that great in the company. Or maybe the markets have changed. But the company goes out to raise some more money, and now it's going to raise another $1 million, let's say. But they're selling the shares for 75 cents a share. Right? So they're actually being sold at a lower price than what I paid for them a year previous. So what this basically says is, okay, if that happens, we're going to take all of my shares and reprice them as if I was making my $1 million investment at the new price. So in essence, I'm going to get a whole bunch of more shares, right? And that's what anti-dilution really is trying to address. What it's trying to address is the valuation at a subsequent round to my investment is lower than when I made the investment. So I am going to be made whole, if you will, in my share price or my share value, which means the company is going to issue more shares of stock to me. And you might say, well, why does that matter? Well, remember, the total outstanding shares always have to add up to 100%. So if I'm getting more, that means somebody's getting less. And the people who are always getting less percentage are the common shareholders, i.e. the founders, the employees, etc. So they're getting diluted more and more, and I have this protection if the price goes down that I can get more shares. Very important concept. There are different flavors of anti-dilution. Full ratchet is sort of the worst. There are other ones that are weighted average, etc. But here again, it's a negotiation point where if someone's hitting you with full ratchet, you might be able to reduce it down to one of the weighted averages. As an investor, as a private equity firm, I want full ratchet, man, because look, I invested in this company and we sort of had a deal. You said you're going to do these things, and I'm going to for $1 million. So I'm giving you the $1 million. If those things don't happen, why should I suffer? It should be the company that suffers. At least that's the logic behind it. Okay, so here's another clause that's pretty important. It's less important to the company than it is to the investor. So this really doesn't impact the company all that much, but what it does do is it impacts investors. So here's what this says. It says, unless, again, a certain percentage of Series A elect to do otherwise, so we can take a vote and undo this provision, but let's assume we're not. It says on any subsequent down round. Okay, what a down round means is what we just talked about in anti-dilution. You sold stock for $1 a share today, But a year from now, when you're raising money again, you need to sell it at 75 cents a share. That's a down round. Okay, so what this is saying is that all investors are required to purchase their pro rata share. So let's say I bought 20% of the company, VC firm number one, today. A year from now, we're raising more money, and I don't want to participate in that round. I don't have a lot of cash reserves. I'm trying to protect my investment, my cash pile, so I don't want to invest. But this is saying, okay, it's going to be a down round, and if I don't invest, all of my Series A preferred shares will lose my anti-dilution rights, will lose my right to participate, and will convert to common stock, and maybe even lose my board seat. So what this is doing is it's fundamentally punishing those investors who invest today, and in the future, when there's a down round, they decide not to invest. And it's pretty heavy punishment. So actually, from a company's perspective, this is a good clause to have in there, right? Because you're sort of providing this incentive that your existing investors continue to invest in you even when things are not going well. So this is one of those clauses. Sometimes you'll see it, sometimes you won't. But it's important to understand what this pay to play provision means. Okay, and this kicks in when it's a down round, things are not going well. Okay, conditions to closing. This is sort of a catch-all, which says that when we agree to this document, there's a whole bunch of other stuff that sort of needs to happen before we're actually going to have the closing, right? So assuming we sign this term sheet, then I, the investor, will complete financial and legal due diligence. We're going to check out the shares, make sure they're not impacted by the blue sky laws. We're going to file a certificate of incorporation, all sorts of kind of legal mumbo jumbo stuff that has to happen. The important elements of this are completion of financial and legal due diligence, right? We're going to want to make sure that the financial statements that the company sent to the investor are actually accurate, right? So hopefully those numbers have been audited. One of the challenges in many young companies is they might be keeping their own books. They might not even have an outside auditor. So sometimes, there's room there for a sleight of hand if you're not careful. But this basically gives the investors a way to exit should they uncover something which was either not disclosed or not properly disclosed or accurately disclosed during these negotiations and in the subsequent due diligence that happens. Important clause, you really can't change this. As a company, it's going to happen. And as an investor, this is where you really, really get to dig into the company and make sure that what you're buying, what you think you're buying, is exactly what you're buying. Okay, lockup. This is very common, and it might get changed depending upon who the underwriter is. So when you decide to go public, so this only kicks in typically when you go public or a public company buys you. Okay, so if you go public, your shares of stock as a founder or as an investor are going to get converted to common shares. And what the underwriter is, so the underwriter is the person who sort of helps take you public, right? They're the ones who create the market for these shares. These are often big companies that we've heard of, Goldman Sachs, etc. What they don't want is, right after the IPO happens, they don't want the market to be flooded with employees or other investors selling their shares of stock, because it'll drive the stock price down. Because they want to try to keep the stock price up, because that's one of the things that's important to them, because they probably own a bunch of those shares of stock. So there's typically this lockup period for 180 days, which basically says nobody can sell their shares for 180 days. You have to wait 180 days. That's 6 months, by the way. It also happens if your company is being acquired by a publicly held company. So, for example, we sold one of our companies to Pandora. So, our shares of the company got turned into shares of Pandora stock, which is a publicly traded company. And we as investors could not sell those shares of stock of Pandora shares for up to 180 days. So again, not very negotiable. It's really the underwriter that defines this, but this is very, very typical. Something to be aware of, both as an investor, right? The IPO, you can't cash out when you really want to cash out sometimes because of this lockup period. Okay, right to participate pro rata in future rounds. So this is sort of the opposite side of the down round or the pay to play piece we talked about, right? So this is saying that if things are going great, right? I bought shares a year ago at $1 a share, and now we're going out to raise more money a year later, and we're able to sell those shares at $2 a share, right? We can raise more money at $2 a share. This is basically saying that I have the right, I as an investor, private equity firm, venture capital firm, have the right to buy the number of shares of stock I need to at the new price, the $2 a price, to maintain my present ownership, right? So if I own 20% of the company, which I bought at $1 a share, and now we're selling more shares of stock to other investors, which would mean I'll fundamentally get diluted if I don't buy more shares. I have the right, I have the legal right to buy more shares so that I can maintain my percentage ownership. So nothing for you as a company owner to be really worried about. Sometimes it gets a little tricky because maybe you want to raise $3 million and the new investor wants to put in all 3 million, and then you end up having to raise another or sell another 750,000 in shares of stock because your existing investors want to participate, and again, those other shares come out of you, the common shareholder or the company founder, or it comes out of the existing investors. It's got to come from someplace. So a good clause, all in all, pretty common. And really, can you negotiate it? Yeah, maybe, maybe not. Hard to tell. Okay, now we're going to talk about basically the board of directors. Okay, so this is saying that so long as the holders of Series A preferred are entitled to elect a Series A director. So meaning as long as the Series A preferred holders have a seat on the board, which again is very common. Oftentimes in a first round financing like this is a Series A, it will state we're going to create a board of directors, and on that board of directors there will be a total of 5 people, 2 of which will be from the Series A shareholders, 2 of which will be from the common shareholders, meaning it could be the founder, and 1 of which may be a neutral third party, someone that together the preferred shareholders and the common shareholders go out and find and agree upon. So in that case, there would be 5 members of the board of directors. But what this is saying is that as long as the Series A preferred holders have a seat on the board, there's certain things that cannot be done without Series A approval. Similar to a previous clause we talked about, there's some subtle differences in this because there are times when a company needs a lot of additional capital and maybe there's going to be a Series B and a Series C and a Series D. There are times when the Series A's shareholders will lose that seat on the board of directors because we don't want to make the board 15 people big. We want to keep it at 7 or 8. We'll add some more people, but at some point in time we run out of seats. Okay, so once you lose that, of course, you don't have director approval. Then you have shareholder approval, which is what the previous clause was about, and that was a function of percentage ownership. This basically says as long as the Series A has a right to have a board member, then there's a bunch of stuff that can't be done without affirmative vote of the Series A directors, right? Meaning, if I'm the one person from the venture capital firm that sits on the board, and I have that right? It's part of the agreement, the investment agreement. There's a whole bunch of stuff you can't do unless I approve it, even if the other 4 directors want to do it. Again, disproportionate share of power given to the investors, which is irrelevant to their percentage ownership to a large extent. So there's a whole long list of things here: additional debt, issue additional shares, sell shares, acquire another company, et cetera, et cetera. But again, gives power to a concentrated set of people. And remember, many of these provisions are here because the Series A investors, or the private equity firm, the venture capital firm, wants to protect their investment, right? They don't want to make this $1 million investment, and then without their permission, you go get if you're the entrepreneur, you go get your 3 friends and your mom and dad and put them on the board, and now you have 7 people on the board, and basically you can do whatever you want because my 1 vote to 7 will always lose, right? So this is saying, I don't care. I always get to approve these certain things. So this slide is just sort of a laundry list of a whole bunch of other things. So there's always going to be some non-compete, non-solicitation agreements, which means this is basically preventing employees from doing certain things. So for example, this is part of that due diligence process that the investor is going to want to review. So they're going to want to make sure that all the employees, or the key employees at least, have non-competition agreements. In other words, they can't leave the company and go work for a competitor. They also want to make sure that all the key employees have non-solicitation agreements. This means that if they go someplace else, competitor or not, they can't come in and cherry pick other employees to come join them, okay? Standard. They want to make sure that all your employees have non-disclosure agreements and intellectual property agreements, meaning you have in place as a company that the intellectual property is actually owned by the company, not the individual employees. Don't confuse the inventor from who owns the patent. So for example, I'm an inventor on a dozen or so patents, but they're owned by several different companies that I work for. I'm the inventor, but the ownership of those resides with the company. So again, as an investor, if I think I'm investing in this company because they tell me they have this great new widget they invented, and I make that investment, and it turns out that Frank Smith, one of their employees, actually owns that invention because the company doesn't have an intellectual property agreement in place with that employee. What basically most intellectual property agreements state is that if I'm an employee of company XYZ, whatever I do that's related in some broad way to what company XYZ does is owned by company XYZ, not by me. I could be the inventor, but the company owns it. We're also going to want to have an employee stock option plan. As an investor in a company, I want to make sure that all the employees, or at least key employees, have some vested interest in staying in the company. In these early stage companies, typically the salaries are below market value. In other words, we're not paying employees maybe as much as they could get in other places, but what we trade for that is stock options. So they get the option to buy shares of stock at a certain price. So that's usually a good thing. In a small company, we're always trying to save and protect cash, and this is a way to do it. Also going to want to have key person life insurance. So for example, if there's a couple of key people in the company, the CEO, the president, or the founders, maybe a scientist or something, I as a private equity investor, and let's say I invest $1 million, I'm going to take out a $1 million life insurance. The company's going to take out a $1 million life insurance policy on those key individuals. So if one of them dies, I at least get my money back, right? Right of first refusal, right of co-sale. what this means is, let's say some shareholder wants to sell their shares of stock. Now remember, these shares are not public shares, they're private shares. But sometimes you can find somebody who's willing to buy them at an agreed to price, whatever that agreed to price is. This is basically saying that I, as the private equity investor, the venture capital firm, have the first right to buy those shares of stock, right? So this is a way that the private equity investor gets to control where the ownership of the company exists, right? Let me give you a horror story, right? So, company co-founder, his brother works for a big competitor, let's say, and his brother owns a bunch of shares of stock because he did made some loans to the company early on, or bought some shares of stock, convertible notes, right? Helped get it started, and he wants to sell those shares of stock to some other company, and that other company is a competitor. I, as an investor, may not want that to happen, right? So if I don't want it to happen, I at least have the right that I can buy those shares of stock. If I refuse that right, then he can sell them to somebody else, but at least I have the right to do that. And we already talked about the board of directors a little bit. This talks about the composition of the board, where the board comes from, how the votes are divided up, etc. And many of those terms we already talked about. So that really concludes the key elements I wanted to go through. I didn't go through every one, like I mentioned. Please review it. If you have any questions about any of them, ask me. But here's sort of the key conclusions I want you to take away from this. The term sheet is the time and place to negotiate, right? There's some things that are negotiable and others are not. But this is the time and place. Once the term sheet gets signed, it's very, very difficult to then push back, unless there's some major finding, that says, well, you told me you had $1.5 million in annual sales, and it turns out you didn't. You only have $600,000 in annual sales because those are long-term contracts, and that money's coming in over time. So anyway, unless something significant happens, this is the time to negotiate, and that's true for both the company and for the investors. And we went through several different things that the valuation, while it's very important, there are other things you can tweak here and there: anti-dilution, right of first refusal, liquidation preference, that can effectively make that stated valuation back on page 1 or 2 either higher or lower than it really is. Some of the terms are boilerplate in these things. They're not negotiable, either way. It's just what they are. The most important thing I want to leave you with is, as an investor or as a company owner, you don't want to do anything in these agreements that makes you radioactive. And what I mean by that is you want them to be as plain vanilla as possible, right? Because if you have some weird clause in this, what happens is that makes you less attractive, or I call radioactive, to other potential investors down the road, right? So if I'm an investor a year from now and I'm looking at your company and you have some really weird voting rights, you and your mom and dad as founders of the company get, 60% votes of the board or something like that, that'll make you radioactive, meaning other people will not want to invest. Or if they do want to invest, they're gonna force you to change that unusual term. So always try to make things as plain vanilla as possible. It makes you much more attractive for future investment. And that's true whether you're the investor or the company owner, right? If I know this company is going to need more money later on, and I'm investing $1 million now, I don't want to do anything that's going to make us less attractive in the future. And to change things always is much more difficult than it is to deal with them at this point in time. So that's my number one thing. Try to make it as plain vanilla as possible, and that's true both for the company and for investors. So hopefully this was helpful to take you through this. Have any questions, of course, feel free to ask them in the forums, But I think we're in good shape, and hopefully this gave you a good overview of term sheets and why they're really important. Thanks.